I'd like to welcome to the stage Shaul David and Sophie Guibaud to the stage. Shaul David is London-based, but has worked with startups as famous or infamous as Railsbank. He was also the UK government's first fintech advisor, reporting to HM Treasury. So if anyone wants to discuss policy, he is your guy. And he is also a reformed banker. Is that fair? Is that a fair, yeah. Sophie is a legend, a living legend. She's the co-founder of Fiat Republic, a company whose vision is to make crypto mainstream. She's also part of the founding team of HelloFresh here in the UK, as well as Fidor Bank. She's also the author, aptly for today, of a book published by Wiley, Embedded Finance, When Payments Become an Experience. And she's also a mentor for many of the budding entrepreneurs and founders in this very building at level 39. So I'm very, very excited for this discussion. Both of these people are incredible fintech OGs, and I hope that you will take as much out of it as I am sure to. Over to you.
Thank you, Nina.
Good morning, everyone. Thank you for coming back from refreshments. And so we're going to talk a little bit about one future of finance. I think we started the morning asking what is the future of financial services look like. And perhaps one of the reason we're kind of struggling to see it is perhaps it's invisible. And invisible in the sense that, and Abu Bakr touched upon it a bit, with banking moving into the communities, into partnerships, into different distribution. And I really liked what he said, that banking integrated into life. I think when we talk about embedded finance, we're talking about user experience, and we're talking about APIs and all that, but that's kind of really sums it up, integrated into life. But perhaps something in a different way in the future. So, Sophie, great to have you on board. Let's start with, and we were talking a lot, and all the writings about embedded finance is about what an embedder can do with it and what the user value is. But is it actually a valuable business model for banks?
Very good question. Let's get into it. No, so I think it's good to take a step back, definitely, at what is embedded finance and how it has come into play. So just throwing back, I started my career at level 39 actually in 2012 in the fintech industry, and back then we were powering fintech wanting to compete with banks. So it was the unbundling, right? The next stage has been neobanks being launched and traditional banks launching neobanks to compete back with fintechs. And then we have seen this rise around embedded finance in the context of brands wanting to launch fintech offering without having to own the stack, so relying on banks, for example, or different type of technology providers and financial institutions to do that. Could be supermarket, could be telecom providers, and it's when the regulation was giving us the freedom to do that in UK and in Europe, at least. And then the next generation in real life, and embedded finance being very much adding value for the users. So in terms of payments, in terms of lending, but basically being here when you need it, but not having to see it or even to think about it. My definitely most striking example back in the days was the first time I used Uber. I don't know if you remember the feeling of using Uber, what happened? I haven't paid, but oh my God, I didn't have this awkward conversation with a French taxi driver asking me to not pay in card because actually he doesn't want to pay taxes. So so there has been this whole evolution and this need from users to have it, and this whole ecosystem in the background working and developing, right? And coming to the point of this ecosystem being made of banks, being made in Europe of EMIs, and different type of financial institution across the world, enabling embedded finance. Now, finally, going to like the creation of financials. Indeed, like payments have become very commoditized, and even more than they were 15 years ago. I think back then, like we could still make quite a good chunk of money, even on FX, etc. And now it's going down, down, down. So is payments enough to justify a move in embedded finance by financial institutions? I guess it depends on the setting, right? So in the context of a bank, there is, of course, always in the background lending, deposits, some kind of structure investment, etc., where like the payments can not even be covered in terms of cost, because it doesn't really matter, because like you're getting all those masses if you are empowering telcos and supermarkets, and basically you're gathering those deposits, you're gathering more users, and you can actually like cross-sell quite effectively. In the context of financial institutions that cannot lend, or that cannot make interest from their users' money, for example, then it becomes more complicated. And it's discussion that we had together around like what's the position of EMIs, and like is banking as service only for actually valuable for banks as a provider or EMIs? My thesis after now almost 15 years in banking as service is that EMIs add value in terms of like bringing together the building blocks and the technology, but they add value on the condition that they have APIs and a technology that answer to specific use cases. So I'm thinking of marketplaces, I'm thinking of what I'm doing, which is empowering crypto platforms that actually cannot open bank accounts. But it's really like answering with very specific user flows, payment flows, which is not what banks would do. Bank generally, they would have like APIs that are a bit one API fit all strategy, very vanilla, but not specific to answering needs of specific users at point of payment need. What do you think? Because I know you have like an opinion.
And I've been involved in an EMI that started or looked for or built a business for 5 years globally, and yeah, when you look at and your book talked about beyond payments, right? Yeah. And we kept looking beyond payments, but we couldn't find how to do that because the banks were not ready. Yeah. And all the conversations we had with bank partners, and those were genuine partners, I don't know where Liz is, rather than vendors, because we were doing something, we were providing a set of products and the bank was selling a different set of products. But we struggled to find the value, a value pool that is big enough to get the banks to really jump in with credit and with other bits with other products in financial services. So, and when you look around, not a lot of people are making money out of embedded finance yet. Now, is that because first iteration was about building other fintechs through banking as a service, and there really aren't a lot of examples of non-financial use cases for embedded finance, or is it just margins that are too low to make a viable business?
So that's a good question. What I just would like to add is that just before I answer into that is we are now in interest world, right? Which we were not for the past 10 years. Yeah. So I feel at the moment the truth is that the question of revenue is kind of answered because you can generate revenue from the safeguarded funds as a banking as service providers, but that doesn't cover the whole discussion about will it be a valuable business model when that goes away. We don't know when it's going to happen, right? I think an important point as well is to realize that embedded finance, I'm sure you have seen some studies around it, but basically like large organizations launching embedded finance, often revenues is actually not the first driver. I'm not saying it's not possible, and we can cover some examples that I have been discussing in the book with Scarlett, that you of course know, but many organizations with like very large audiences are actually launching embedded finance payments at the point of context, lending at the point of context, as a way to actually increase customer stickiness and increase their loyalty, increase brand engagement, and eventually make revenues. And I think actually it's very much what happened for Shopify and Grab. Mm-hmm. I don't think they started thinking, wow, financial services will become, within like 2 years of launch, 50%, more than 50% of our revenue. Yeah. And now it's probably, 70 or something like that.
Yeah, but the point of a higher interest rate environment, it's keeping businesses alive, it's keeping use cases alive. Yeah. But I think what we're missing is that, when it comes to the user, how much revenue, how much interest you expect to get on deposits, you always get more from the bank. Yeah, because the bank doesn't have to share,
and also because as an EMI you cannot give interest.
How do you? I think that's changing, by the way. Yeah. In some markets, Israel is the first.
Not in the UK or Europe.
But I think the UK is. I know the UK is looking at it. It might change soon. But you can call it. You can call it other. In other names, just not interest. Yeah. But so we're going back to the bank. Yeah. And if there is a viable business once you find lending, how or is it possible to keep or build two direct consumer business on one hand and an embedded finance business under the same roof?
So
how do you do that?
Yeah, so that's also a very interesting question that I went through during my Fidor days. Actually, Fidor was a challenger bank launched in Germany, the first one actually bank launched in more than 100 years. They were one of the first banking service companies. And we experienced firsthand, so we launched the community bank as retail. We grew it to, back then, I think 400,000 members. That was literally 2008, so that was really very much the beginning. And out of the success, many organizations came in and said, I want to do the same. So that's how Fidor created their banking as a service offering. It was successful. It got sold to Sopra Banking Group, and it's still developing. But as an organization, having to maintain both the retail part and the banking as service part was extremely complicated, because the culture that you need, or the people you need for the retail part, are not the same people you need for the banking as service part. Servicing retail customers, it's answering to people queries, making sure that your service works, making sure that you develop the features that are needed. When you serve clients from a banking as service perspective, it's their customers, and your customer is this organization, and you actually need to run your company as a tech company rather than a bank, even if you can run your organization as a tech bank, but it's just not the same people, not the same processes. It's very different. So back then, I don't feel we found the exact right formula, and I'm yet to find actually an organization that has done that. But I'm curious to hear your thoughts on someone doing it well.
I think time will tell whether they do it well or not. But we're certainly seeing, so there's two types of banks that are heavily engaged in embedded finance. One is obviously in the US, where the regulatory framework is very different. You can't have a regulated platform. There's no concept of EMI. So the sponsor bank model there is very common. Again, I don't think that a lot of them are doing extremely well in terms of revenue and profitability. But they also, most of them don't have a significant amount of direct to consumer. They have to have a bit because of the regulation, but most of the business is shifting into embedded finance. So I don't know if that's something that can be done here. But what we see in Europe are three, I think, really interesting examples that are in the early stages. One is SEB in Sweden. The largest bank in Sweden. They have an existing relationship with all the big brands and the retailers, and they have just launched an embedded finance program with the largest retailer. It's an Axel Johnson company. I can't remember its name. But they're going big. They're going straight into the largest pool of customers, and we'll see what they're doing. When I was talking to SEB at the time, my question was, how are you going to be sure to keep the attention of a board level at SEB to continue to divert resources and capital to a new business? And I got obviously the usual answer that yes, if the business is successful, then we'll have it. And then the other two are obviously NatWest in the UK, who built NatWest Box. Haven't launched it yet with a customer. They're supposed to be a big retailer in the UK. It's coming, I'm told, but not yet there. And then the latest entry is a UniCredit in Italy, buying Vodino, which is a embedded finance provider, a tech-only company, and Iron Bank that was part of the Vodino group. So I don't think that there's an example of a successful embedded finance. But I think the point of what NatWest and UniCredit do of buying resources, buying capabilities from the outside and keeping those capabilities relatively separate from the mothership could be the way forward.
Yeah. I think what is also important to discuss. So yes, you can definitely keep on the organization separate, but there is also what's the risk tolerance of your board, right? Because there has been a lot of scrutiny when it comes to banking as service. All across the world, so US regulator, UK regulator, Lithuanian regulator, etc. And the truth is that banking as a service has emerged to fulfill a need, which was to let fintech sector grow. Basically, fintechs needed help and piggyback either on bank and EMIs. And I feel that the framework has been working, but probably not covering as in the most adapted way the pitfalls of what can be banking as a service and embedded finance, which lies on making sure that when you start adding layers and being so far removed from the customers, you still maintain you still have a very deep understanding of your flows, of the people behind, of what people are making with the money, and eventually prevent money laundering. I think it's possible. I think specifically the models actually in the US, and bearing in mind, as you say, it's not as successful, but the model where it's the bank keeping on doing the KYC is probably the way forward in from a regulatory standpoint to the risk. But we cannot ignore the fact that it's a riskier model than a retail one or even a corporate one, and boardroom level, you can see like your business unit making money, ramping up the revenue, but equally you can see probably the noise from compliance team telling you, yeah, but it's starting getting very risky.
Yeah, but this is the compliance team that has grown up in a D2C environment.
Yeah.
Maybe not necessarily understanding all the intricacies of embedded finance. But the last question is, and you mentioned regulation, right? And the regulation, and Alessandro also mentioned it, is lagging. It's always been lagging. It probably will continue because they have to see what the market is going and then respond to that. How should banks then kind of approach building a Baas business when the regulatory framework is not yet clear? What do you do?
I guess you work with some people that actually have worked with the regulators in the past to really like kind of, bringing this knowledge in, and potentially people that have also been doing that for the past 15 years. I would say it's the best way forward rather than trying to reinvent.
I agree. I don't think we're doing that enough. I don't think. I think it's on us and obviously anybody in the business to take the regulator on a journey. And if we're thinking about Africa, probably even more so. But we're not doing it well enough, and certainly being paraded into Congress after the challenges in the US is not a great look for a sector. We've only got a few minutes left. Are there questions from the crowd? There's one. It's two. Oh, you got to grab mine.
I'm always running in these heels, I tell you what. I'm getting my steps in.
Sorry, Charles, I feel guilty now. So I'm Dan, I'm from Vavita. We're like Wise turned on its head, so we help students and others that are relocating from the emerging world move money out to wherever they're relocating to. So my question is, does Baas as a business model have a finite lifespan and kind of role to play? And the reason I ask that is I think the huge number of fintechs that the model has enabled, coupled with the just enormous availability of capital over the last 10 years, has enabled lots and lots of competitors to jump into what is a market that really lends itself to scale and consolidation. So 20 to 30 years from now, should any Baas providers have a role, or should big banks have consumed that entire market back up just as they have done for the last 200 years?
Okay, no, I think it's a great question. So I think indeed without Baas we wouldn't be where we are fintech-wise, because it has been a massive enabler, even of the big names, like Revolut, TransferWise, etc. They all started this way. But I think the real question is more, who will be the organization that are doing Baas in 30 years? Because the truth is that, is there a reason for those organizations to actually not keep on working with banks? Maybe not, like they can still do correspondent banking, like use some infrastructure. Do they have really an interest at all time to be like replacing those infrastructure and not becoming, for example, of agent of Barclays, etc.? I think there is still definitely a use for that, even if like for those banks, it's a very low margin play, but they still have an incentive in getting the collaboration going, just to get the capitals from those companies to do other things with it. So I think Baas will be still around. That would be my wide guess, but I would say that it's going to be probably closer to banks than it has been to EMIs, and just keep on like the EMIs for, again, very specific flows.
Yeah, no, I agree with that, and I think, and because the margins are coming down on a lot of the sort of vanilla products, and lending is where money is. Therefore, balance sheet is king. Cash and balance sheet are kings. So even EMIs will eventually, with scale, I think, look at a banking license as the next growth for them. So it's great to start as an EMI, but you want to grow beyond that. Having said that, It's not a winner takes all market whatsoever. We'll see a few banks, and I think we'll see a few non-banks getting the scale.
Yeah, brilliant panel. Fiserv has the little license in Georgia.
That's true. That's from last week, yes.
But what does that do to the American kind of opportunities? And also Clearbank getting their license into Europe, Paul Staples and sort. Those sort of things can really move the needle rather than little projects like Aon and Unicredit.
So first of all, with FIS and their license, I think that's a really interesting one, and it puts FIS in conflict with their main customers. Why would they go after the business of their customers? I don't understand. I think they will do some stuff sort of ancillary to their core business, maybe showcasing it, but their revenue comes from their big clients. And I think that's going to continue to be the case for them. Clearbank is a great example. I think they've done really well over the last couple of years. But again, UK market focusing on financial services only is a limiting factor for their growth. So they have to expand either geographically or market segment-wise. I think they're going to do both.
Nothing to add.
Megan?
Just thinking about the customer experience aspect of embedded finance. I mean, on the one hand, you can access a financial product or service from a brand that you're highly loyal to that already provides an exceptional experience. On the other hand, financial services has to have a bit of friction in the experience just by the nature of the industry and for keeping customers safe. So, I mean, the thing I always think about is, like, I think of which brand has the best experience that I love that I would never give up, and it's Spotify, right? The Spotify experience is just incredible. But what happens if Spotify makes an embedded finance play, and then all of a sudden I'm used to this exceptional, fast, personalized customer experience, and then there's some hiccups with the wallet, the payments, or something from an embedded finance play. And I think to an extent we saw this with Apple and Goldman Sachs in the US, right? Customers were used to exceptional customer support from Apple. It was coming from Goldman Sachs. There was a big uproar. They're now, I think, in a divorce. I think Amex may be picking up the partnership, and there's a couple other providers. So how do you address that, these opposing forces between having an exceptional customer experience but also having that necessary friction in a financial service product?
So that's a good question. We are actually also discussing that in the book. The fact that, like, indeed, when it's too smooth, then you don't know what you're doing with your money. Like, you're not even noticing. I think, I mean, you're the expert on this one, but bottom line, it's about making sure that people know they are spending money. But if you think about an experience at the supermarket, like, and you need to buy something, like, let's not set aside the consumerism thing, but the fact that like, you need to buy something on the spot, your supermarket is offering you the loan because they know you're coming every week, they know how much you spend, they know actually like what you are buying, and they can get data through open banking about you and do an instant assessment. It makes so much sense. Imagine you really need the thing and you need to log in online, ask for a loan to your bank, and actually you need more than like the minimum you can get, and then it comes back in 2 days. It just doesn't work. So for me, that's the reason, but yes, that's the reason why, like, it makes so much sense to have embedded finance, and so it's basically payments and lending at the point of context. But I agree with you, we need to be careful. It just makes me think of a little story that is a bit in this context. I don't know if you have read Amazon Fresh and what happened.
Yes.
Nina, you want to tell the story?
For those of you that have not experienced it, Amazon Go or Amazon Fresh?
English, US. So it's
Oh.
the same. Yeah,
Okay.
they don't have the same brands.
So
but yeah.
here in the UK, there were Amazon Go shops where you would walk in, signed into your Amazon account. You could pick up whatever you wanted off the shelf, put it into your bag, and walk straight out as if magic. Only to find a few months ago that AI actually was short for Asians and Indians, because it was actually a bunch of Indian customer support workers who were watching videos of what people were picking up and putting into their baskets, and not in fact actually any NFC technology or actual AI. It was just my brethren in India watching you shop.
But
Yeah.
I didn't know that. That's brilliant.
The real AI, Asians and Indians.
But to answer your question, Megan, for Spotify, and I think we need to take it a step back and like, what is the value proposition and who is it for? And what embedded finance should not be is building Monzos for some brands. So Spotify doesn't need a Monzo. Man United doesn't need a Monzo. But what Spotify might need is perhaps not even in the on the consumer side, but maybe on the provider or the artist side, which I think they're looking at anyway. And how do you enable bands and artists to get on the platform, create, be part of the creative process, and all that sort of stuff. And then you're not really trying to change an existing interface or experience, but build a completely new one. And I think we need to be focusing on specific use cases like that, co-create with the bank, add the friction where it's needed, and avoid it when it's not.
Fantastic. I'm afraid I'm going to have to cut you off there because we're just going to go down the rabbit hole. Can we please give a warm hand to our Fireside chat?